All right, let me start broadcasting. Good day, everyone. Welcome to our webinar. Actually, we're about 2 minutes early, so I wanted to come in early and give everyone the opportunity to go ahead and log in, because once I'm logged in, then all of you can come into this webinar. So once again, I'm excited to be here. So we're going to get going at about 2 minutes. I have a lot of good information to share with you. So buckle up. There's a lot of information. You may use your cell phone and take some pictures of the screens that I'm going to be sharing with all of you. For those of you that have pen and pencil ready, start taking some notes once we get started, because this is about the major sins in retirement. And what I have done for this webinar, I have set it up as questions that I ask a lot of the clients that I engage with for the first time. And I would imagine that these are the type of questions that each and every one of you should be getting from your financial advisors. Now, if you're not getting these questions as you start to prepare for retirement, then obviously you need to take a look and consider your options when it comes to working with someone that is not either a retirement strategist or a tax planner from a business perspective. So let me check in so we get more and more people. We already have some people that are signing in. And let me look at the time, because I don't want to keep you waiting. I'm going to give it 30 more seconds, and then I'm going to get going on this. This is going to be fun, because what I'm going to do is I'm going to be sharing my desktop with all of you so you can see my presentation. And then obviously, hopefully, I'm going to be able to answer a lot of the questions that you may have and the concerns. But what I'd like to do from a business perspective is to kind of help you kind of think outside of the box, because most of us, as we start getting ready for retirement, we think along the same lines. And I think it's important that you start to take a look not only at your retirement options, but also at your decision-making process when it comes to retirement. You ought to start looking at it through a telescope as opposed to a microscope, because the view is going to totally change, and it's going to make the world a lot easier for you. So let me go ahead and share my screen with all of you. You'll be able to see it in the next minute or so. Let me take you over to the presentation, and you should see it now. The name of this presentation is Major Retirement Sins. So once again, we're going to talk about some of the critical questions that all of you should be asking yourselves, and your advisors should be asking you when it comes to retirement distribution planning. Now, obviously, don't get upset, because I'm going to say some things that may not be suitable for the way that you're doing business and planning. But if something is going the wrong way, well, I would imagine that this is the right time to learn a little bit more about it. So with that being said, once again, my name is Bert Salazar, and I'm going to be the host for this webinar today. I hope you enjoy it. I would love to get some feedback from all of you, and let's get going. All right, so Benjamin Franklin, which is someone that I've done a lot of reading about for many years, he said a very long time ago that, if I have 8 hours to chop down a tree, I would spend 6 hours sharpening my axe. And I would imagine that one of the reasons why you're here on this webinar is so you want to sharpen your axe as much as you possibly can. The more information, the more knowledge that you acquire, the better your decision-making process is going to be, not only for you, but also for your family in retirement. Remember that one of the things I always say is that although there's more information in the marketplace than ever before, Americans are worse off than they've ever been. And the reason for that is that information without education always leads to failure. So my goal today is to provide you with education that you can take with you. And then obviously at the end of the day, if you want to use my services, or you want to reach out and you want to pick my brain about anything that may be keeping you awake at night, I'm going to give you my information so you can then reach out. Although I do have a number of clients on this call as well, and you guys know how to get a hold of me. So now, what are some of the critical retirement questions that we're going to be discussing today? Number one, how old will you be when you run out of money in retirement? And that's a really big one for you to be able to answer. Now, I would argue that most of you have never done any type of calculations to figure out, whether you're going to run out of money before you run out of life. And if you are going to run out of money before you run out of life, how long will it take for you to run out of money? And those are calculations that are very prevalent and very important for each and every one of you to conduct, or for someone that you're working with to be able to acknowledge and help you with along those lines. Question number 2, how much income will your retirement savings produce? Now, you know where you're at today. If you're maybe 5 years away from retirement, you're probably still putting money away in your retirement accounts and so forth. And then you can do a fudge factor of an interest rate that you think you may be able to get, and then try to figure out what's going to be that retirement income that you're going to be receiving at some point in time in the future. And we'll discuss those as well. Question number 3, how much income is needed for your desired retirement life? Now, everyone wants to have the best possible retirement life. So now you got to compare, okay, how much income are my assets going to be able to produce safely without having to take a tremendous amount of risk? And then on top of that, what type of lifestyle do I want for myself and my family? And am I going to be able to meet those accordingly? Question number 4, how much will taxes impact your retirement accounts and net income? At the end of the day, we're living in a very low tax world, but things are going to change dramatically very, very soon. As a matter of fact, the tax laws are going to change again January 1 of 2026, and I can tell you that taxes are going to have to double in this country, or we're going to go bankrupt. So we're going to talk a little bit about that and figure out, what are you doing right now based on your retirement accounts in order to avoid that tax Armageddon that is going to be coming our way in the not too distant future. Question number 5, how much of your retirement income is guaranteed? This one is extremely important. Question number 6, what percentage of your retirement income would you want guaranteed? So the question to you now is, well, how much of your current assets and your current income in retirement is going to be guaranteed? And then in a perfect world, what percentage of those assets and that retirement income would you like to have guaranteed? There are 2 different questions that we'll address as well. And then obviously, how much will your retirement income go down if the stock market crashes? And that's something that you better do your due diligence, because it's going to happen over and over and over again, and it's going to happen in retirement, and we'll discuss that as well. And then last but not least is, do you have your money in assets that grow in value but are protected from stock market volatility and stock market crashes? So if you are working and preparing your retirement plan, and you're not able to answer each and every one of these questions, I would argue that you really don't have a retirement plan. You probably have a hope plan. The challenge is that hope is not a financial strategy for any of us in retirement. So let's go ahead and address question number 1. How old will you be when you run out of money in retirement? Well, you have to take a look at longevity and longevity planning in the United States and the longevity issues that you and your family may have to deal with. So for instance, if your parents lived a long life, or they're still alive, because we're probably in the sandwich generation, some of us may be taking care of our parents and taking care of our children at the same time, then you got to figure out longevity. One of the things that I can tell you is that Americans are living longer today than ever before in history. As a matter of fact, if you're going to plan for retirement, you have to be able to plan for 3 decades, 30 years in retirement. And I call those years the go-go years, the slow-go years, and the no-go years. I'll give you a little bit more detail on that. But longevity is prevalent. Longevity is happening to the vast majority of Americans. And the longer you live in retirement, the more income you're going to need. And therefore, the more assets you're going to need in order to generate that kind of income that you're going to necessitate at some point in time in the future. Withdrawal rate risk, and that's another big issue. How much money are you going to take out of your retirement accounts? If you take too much, then you're going to run out of money before you run out of life. If you take too little, then chances are you're really not going to have a successful and exciting retirement life. And then, that's something that none of us want. We want to make certain that we can enjoy and catch up because we've been working all our lives. We have been putting money away for many, many years. Now we want to be able to enjoy it. But if you're not properly structured in your retirement distribution planning, fear is going to govern every decision-making process that you're going to take. And if you're going to make a decision based on fear, chances are you're not going to be making the right decision at all. Now, the sequencing of return risk is another big issue, and we'll discuss that as well. And the sequencing of return is that it's not only how much money you're going to take out of a given asset. Let me give you an idea. If you have $1 million portfolio and don't pay attention to the number, it could be $500,000, it could be 200,000. I'm just giving you $1 million because it makes sense from a numbers perspective. Traditionally speaking, you should not take more than 3 to 4% of the value of that portfolio every year. So preferably, you would only want to start taking income and interest out of that portfolio as opposed to invading principal. The challenge is that because of longevity planning and because of the sequencing of returns and the stock market volatility, most economists and financial experts will tell you that you should not take more than 3% out of your retirement assets. So if you have $1 million portfolio, that would generate a $30,000 of income annually, and that would be before income taxes. So right there, you can tell that $30,000 is not a lot of money. So $1 million portfolio is only going to do so much for you. Obviously, the more you have, the better you're going to be. But then on top of that, you have to add the sequencing of returns. There's some years that the market is going to do well, and perhaps you can take a little bit more. But there are going to be years where the market is not going to do so well, or the market is going to crash, and you're either going to have to take a lot less, or some of you may have to give up taking any money at all. But then again, you're not employed, you're not generating income, so the only way you're going to be able to survive is by going into those assets that are depreciating in value from one year to the next and take enough money out in order to maintain your standard of living. And then what is that going to do to the overall portfolio? Because now you're compounding the problem because you're taking distribution out of an asset that is dropping in value very, very rapidly. So those are things that you got to start thinking and preparing for if you want to have a successful retirement life. Now, inflation and taxation, it's here to stay. Inflation is the silent killer of retirement assets. Let me give you an example. In 20 years, you would actually lose 50% of the purchasing power of your retirement assets today. So if you have $100,000 in a portfolio today, and let's say you're age 65, in 20 years from now, that same $100,000 will only be able to purchase $50,000 worth of goods and services because the rest of it went away to inflation. Now, if you do it over a 30-year period, that same $100,000 will only be able to purchase $33,000 worth of goods and services. So you're going to be losing 66% of the purchasing power in those $100,000 just because of inflation. The other thing to notice is that inflation is not tax deductible. So if you have a 3% inflation rate in the United States, you have to, on top of that, add your tax rate. So when you finish paying taxes at the end of the year, that you would still have that 3% increase in order to meet or perhaps even exceed inflation. So you may have to generate a 3.5%, a 4.5% rate of return depending on your tax bracket in order to net out that 3% that is going to help you hopefully offset inflation. And then taxation, obviously, is going to happen every single day, no matter what. There are two things that are certain in life, and that's death and taxes. So the challenge is that if you take a look at where we're at today from a taxable standpoint, we are at historically high debt and historically low taxes. Other than the very beginning of the IRS code in 1913, and during the period of the Great Depression, we're now living in the third historical lower tax rate in the history of our country. So that tells you that if you're not prepared to mitigate taxation, then chances are you're going to have some major problems in the future because, look, our national debt is at $24.5 trillion. Our unfunded liabilities for Social Security, Medicare, Medicaid, and Medicare Part D is at $144 trillion. And right now, our national deficit is at $2.5 trillion. That means that we're actually spending $2.5 trillion per year more than what we are generating in revenues from income sources based on the US government information that I receive on a monthly basis. So there's no doubt in my mind that taxes are going to be a lot higher. The question is, how are you protecting yourself and your assets from that tax Armageddon that is going to be coming down the pike? Now, let's go to, at this point in time, let's go to obviously asset depletion and eroding factors. A lot of those are going to play a major role on you. And asset depletion and eroding factors, taxes, inflation, stock market volatility, interest rate volatility, propensity to consume, life happens, lawsuits, all of these things are going to have a negative impact on whether you're going to run out of money before you run out of life. Now let's go into question number 2. I think we've talked a little bit about question number 1. And by the way, that's just the very beginning. There's a lot more that I discuss with clients because I want to make certain that they're totally prepared, once we do our tactical retirement blueprint for them in order to make certain that they're going to be successful in their retirement life. Now let's address now question number 2. And this one deals with how much income will your retirement savings produce? And once again, you have to be able to do your due diligence. Don't be too aggressive. Don't be too conservative. You should be somewhere in the moderate range and figure out where it is that you have your assets invested and what kind of a safe rate of return can you obtain on those assets. And again, use the benchmark of the $1 million portfolio and the fact that you should not be pulling more than 3% unless you've done some proper distribution planning. If you've done proper distribution planning, then you could pull 6, 7, even 8% out of your retirement assets and not have to fear that you would run out of money before you ran out of life. But most Americans have not done that due diligence, and I would argue that many of you on this call have never done that either as well, but hopefully you have time on your side of the ledger. Now, one thing that you need to consider as far as how much income will your retirement savings produce is consider the difference between an average rate of return and an actual rate of return. Now, what do I mean by that? Let me give you an example. Let's say that the market drops 50% in year 1 and it gains 50% in year 2. The average rate of return for that 2-year period is 0. And by the way, the mutual fund company that you invest your money with will actually report that the average rate of return for that 2-year period was 0. On the other hand, what is the actual rate of return to your portfolio? So let's say that you had a $100,000 portfolio. In the first year, you lost 50%. So you're now down to $50,000 in the portfolio. Then in the second year, you gain a 50%. But you don't gain that 50% on the original 100. You gain that 50% on the 50,000 that you have remaining at the end of the first year. So when you gain that 50% on that 50,000, it brings you up to $75,000. So although the average rate of return for the 2-year portfolio was 0, your actual rate of return was a negative 25% because you started with 100 and then you ended up with 75. And on top of that, what if you had to take distributions while the stock market was hitting your retirement assets and now you were down to $50,000? You would have never recovered, and you may never recover and get back to the 100,000 that you started with originally. Now, Also consider, what is your current asset allocation compared to your future asset allocation? As people get older, do you think they want more risk or do you want less risk? Do retirees want more risk or do they want less risk? Because of the fact that I'm a retirement strategist and that I've been a tax planner for 30 years, I deal with a lot of pre-retirees and retirees, and I can tell you that all my retirees want guaranteed income and they don't want to take any more risk than they have to in the market. Another question is, are your retirement assets in stocks, bonds, foreign investments, personal business, real estate? Some of you may own a personal business. Some of you have been running a fairly successful business and now you wanna get out. Now, perhaps you want to get out on a full-time basis or on a part-time basis. Perhaps you have a family member or a son or a daughter that may take over the business. So those are things, every person is going to be a different world, and that's something important to consider. And then, will this retirement income that your current assets are producing, will they be able to stay ahead of inflation? Just go through the exercise that I covered. That's another question that you need to be able to address and be able to identify. Now, let's go into question number 3, which is how much income is needed for your desired retirement lifestyle? Because we all desire to be on top of the world. So now you got to be able to compare. Now you got to be able to say, well, is it the same as the current retirement, as to what the current retirement assets can produce? So is your desired lifestyle the same as the income that you're going to be generating or you're currently generating from your retirement assets? I would argue in most cases, the answer is no. And if the answer is not, then what is the retirement income gap? So you may have a champagne taste, but you only have beer money. So what is the arbitrage between the two? And number 3 is, how long is that gap going to last? Is it going to last just for a few years because you may have some additional income coming in at some point in time in the future? Or is that going to last a lifetime? And if you want to catch up and kind of bring both, bring the gaps or the gap closer together, what do you have to do on a guaranteed basis? Because you don't want to use non-guaranteed assets in order to do that. Again, these are questions that are very, very important for all of you to consider as you start thinking about retirement. By the way, planning for retirement is easy. Putting money away, investing in your 401ks, IRAs, your municipal bonds, or your real estate, whatever it is, that's easy. Once you get to the summit of retirement, that's when it becomes a lot more difficult, because you're going to have to deal with issues and you're going to have to make a paradigm shift in the way you think about retirement that you had never thought about, because it is no longer about the accumulation rate. It is all about the distribution rate. Now, let's go into question number 4. By the way, there are 8 questions, so we're almost halfway through at this point in time. Question number 4 is, how much will taxes impact your retirement accounts? And most important, your retirement income. So will taxes be higher, lower, or remain the same in the future? I would argue that taxes are going to be a lot higher in the future than they are today. What's your bet? Are you willing to make a bet? Are you gonna bet on the side that taxes are going to remain the same? Or are you going to bet on the side that taxes are going to be a lot higher than they are today? Or are you going to bet on the side that taxes are going to be lower? I can tell you this because I do accounting and tax planning as well. For a lot of my clients, even if taxes were not to go up in the future, which I know they will, your tax liabilities may actually be greater in retirement than they are today. Why? Because a lot of the deductions, exemptions, and credits that you were able to obtain while you were working, once you're retired, they're gone and they're done. So therefore, your personal income taxes may actually go up. And not including if taxes actually go up in the United States as they're forecasted to go. Now, what percentage of your assets are in the forever tax bucket? So I would tell you that of all the audits that I do for retirement accounts, 95% of all my clients have all of their retirement assets in the tax deferred bucket, which is equal to taxes forever. And those are your 401ks, your IRAs, your 403bs, your TSPs if you're a public employee, your DROP, your deferred retirement option programs, all of your pensions, all of those assets and the income that those assets generate are fully taxable to you in retirement. So what percentage of your assets are in the forever taxed? You have to do your due diligence, and that's important for you to note. What percentage of your retirement assets are in the never taxed bucket? And just to give you a little bit of a flavor, when it comes to the IRS code, there are three major tax buckets that you need to deal with. You have your taxable bucket, your tax deferred bucket, and your tax-free bucket. The taxable bucket are your emergency funds. You know, those are your CDs and your money markets and maybe your traditional mutual funds. The money that you put in is after tax. The money gets taxed every year because you get a 1099 every year and you have to report it for taxes. And then when you sell the shares and the investments in those assets, you're going to have to pay taxes again, and that could be ordinary income taxes or capital gains taxes. So from a taxable standpoint, the tax deferred bucket is definitely not a good bucket from a taxation perspective. On the other hand, I recommend that every one of my clients have money in the taxable bucket because those are your emergency fund dollars. That means that you should have 3 to 6 months of expenses in that account. Sometimes you can have a little bit more. Maybe you're going to be making an investment. You're going to find some business opportunities and you want to park some money there for the short term. Okay, that's okay. But you have to have an optimum amount and you cannot have any more than that. Now, the tax deferred bucket, we just talked about that. You know, those are the 401ks, the IRAs, and all qualified plans. The money goes in pre-tax, they grow tax deferred, but everything coming out is taxable. And there's an optimum amount that you should have. And for every single one of you, the optimum amount is different because it is based on your taxes and your tax liability and safety net. And then the tax-free bucket is actually the best bucket to own, except that the vast majority of Americans don't have that many assets in that bucket. And that includes your Roth IRAs, your Roth 401ks, your 7702 plans, which are your cash value life insurance plans. And then last but not least, your municipal bond funds. Now, the municipal bond funds, you have to be careful in the tax-free bucket because although the income that you generate is on a tax-free basis from a federal income tax standpoint, they do hinder your ability to collect your Social Security benefits tax-free, and I'll explain that to you in the next few minutes, and maybe even your Medicare premiums may be higher in retirement as well. So at the end of the day, what you have to be able to do, and I know that most of you have not gone through this exercise, you have to take a look at all your assets and not only do an asset allocation, but also do a tax allocation along the way and figure out what percentage of your assets are in the taxable bucket, the tax deferred bucket, and then the tax-free bucket, and be able to measure those and handle them accordingly. What percentage of your retirement income will be fully taxable at retirement? This is a very big one because depending on what percentage of your assets are taxable in retirement, along with inflation and along with guaranteed income, it can determine success or failure in a retirement account. And this is something that, because I am a retirement strategist, that's what I specialize in working with my clients on. And last but not least, under question number 4 is, have you created a tax-free retirement plan? And if so, what does it look like? And what are the steps that you're taking in order to maximize the contributions to that tax-free retirement bucket that we have been talking about for the last few minutes? Let's go into question number 5. How much of your retirement income is guaranteed? Let me put it to you this way. None of my retirees would give away their guaranteed income in retirement. I deal with a lot of public safety employees, police and fire, FBI, DEA, customs, law enforcement officers. And they all work in the public sector, and they have all retired, and they have a guaranteed pension coming to them. Every time I have asked any of them if they would be willing to give up their guaranteed pension, you know what they say to me? Hey, Bert, what do you think? I'm crazy? I'm never going to do that, because there's nothing more important than all you have to do is wake up on the green side of the grass every day, because you know that the first of the month, there's going to be a guaranteed paycheck coming into you from different sources that you may have set up along the way. So is your current retirement plan providing you 100%, 75%, 50%, 25%, 0% of guaranteed income? Try to figure out where your income sources are and whether those income sources are going to be guaranteed to you. Now, if you're receiving and will be receiving a Social Security benefit, then you know that's a source of guaranteed income. And that's important. But anything other than Social Security benefits, do you have anything else? Do you have a guaranteed pension from an employer? If you do, I congratulate you, because you would be at the top 1% of the food chain, because the vast majority of Americans do not have a guaranteed pension, although you have the ability to create one, and that's not a conversation for today. Now, where are and what are your guaranteed income sources? So again, try to figure out, if you're going to generate income from accounts that are going to give you guaranteed income for life. Are these sources inflation protected? So for instance, going back to Social Security benefits, there is an inflation protected asset inside Social Security. So therefore, as inflation goes above certain thresholds on an annual basis, so will your Social Security benefits. Now, there may be years when you're not going to receive an increase in your Social Security benefits, and there are other years that you will. More than likely you will, but there have been a few years in which you would not, or you had not. Are these sources tax protected? So it's not only the fact that, yes, Bert, good thing I'm getting certain sources of guaranteed income, and that guaranteed income is increasing on an annual basis. But then are they tax protected? Because if not, yeah, your income is increasing, but so is your tax liability. So you may not be doing the right things with your retirement assets. So there's a way that you can maximize the retirement income and also minimize your tax liability in retirement. So far, so good. Hopefully, I'm getting you to start thinking outside of the box, because that's my entire goal for each and every one of you on this webinar today, for you to start to consider things that perhaps you really hadn't thought through prior to this workshop today. Now let's go into retirement question number 6. What percentage of your retirement income would you want guaranteed? I'm going to repeat that question, because the answer that you give yourself, or that you can put in the chat box and give to me now, will determine, how smart you really are. So once again, what percentage of your retirement income would you want guaranteed? If you didn't say 100%, there's got to be something mentally wrong with you. And I'm not kidding about this one, because in a perfect world, you would want every single dollar in retirement to be totally guaranteed to you. Remember, retirement is about retirement distribution and distribution rates. And it's also about receiving guaranteed paychecks for the rest of your life. Therefore, you don't have to worry about running out of money before you run out of life, because these guaranteed paychecks will be there with you until the day you die. And then upon your death, they may continue to your surviving spouse. So it really depends on how you set them up. Now, have you considered any guaranteed income sources lately? If you haven't, I would encourage you to do so. Either go back to your financial advisors and talk to them, But if you're not comfortable having that discussion with them and you want to reach out to me, I'll give you my information at the end of the webinar. And then you can feel free to reach out to me at no cost or obligation. So this is something that I do. That's why I put out a lot of videos, and I have my own podcast. I just yesterday finished my 109th podcast. I do a podcast every single week, and all I try to do is provide you information, but mostly financial education. Are these sources inflation protected? Once again, if you're considering some of those, are they inflation protected? Hopefully they are. Are these sources tax protected? In a perfect world, you would want to have inflation protection and tax protection by the same token. Now let's get to retirement question number 7. How much will your income go down if the stock market crashes? That's an important one because we just went through a bear market. Now we're still there. It's recovered a little bit, but I'm very, very concerned on what's going to come right behind it, because we have been dealing with this medical pandemic, but it is also a financial pandemic because the economy in this country has come to a complete halt. Now, I know our president is very optimistic and that the economy is going to recover, and it will. But how long is it going to take for the economy to recover? And how long are you going to be in retirement, or when will you be entering retirement? And if that is the case, what are some of the liabilities you're going to have to deal with? What's going to happen with unemployment? What's going to happen with bankruptcies in the US, both personal and business bankruptcies? What's going to happen to the real estate market and foreclosures? And what impact is that going to have with inflation, deflation, and so forth? And how is that going to govern your overall return on your retirement assets? Do you think that, will it be more or less than 30%? So if the stock market declines, will your income go below 30%, down by 30% or more? You know, that's an important question for you to answer. So it also depends where you have your retirement assets today. And that's critical from a business perspective. Will that drop in income impact your fixed or your variable expenses? You know, some of my clients, when they set up a principal protection program, they want to guarantee not only their fixed expenses, but also their variable expenses, or at least up to a certain level. You know, so if the market crashes, is that going to have an impact on your entire lifestyle or only a portion of your lifestyle? Have you conducted any financial calculations to determine the financial arbitrage? What would happen if the market drops 30% and so do your assets? Are you going to be able to make ends meet with that 30% differential in income coming in out of those assets? And will it be feasible, or will it be impossible for you to invade those assets that have just dropped 30% and continue to take more money out of them as the market continues to head south? And then question number 8, do you have your money in assets that grow in value but are protected from stock market volatility and crashes? Do you have your assets in retirement accounts that can grow in value but are also protected from stock market crashes and stock market volatility? That's like having the best of all worlds. So what is your current principal and paycheck protection program? Do you have one? Do you have a paycheck protection program for your retirement life? And if you don't, there's a very high probability that you're going to have a failing retirement life. And that's not something that you intended to do. But always remember that the road to hell is paved with a lot of good intentions. If the stock market drops 30%, can your retirement assets remain steady without losing value? More than likely, not in your case. So if the market drops 30%, can your retirement assets continue to produce the same amount of retirement income that you were receiving prior to the market crash? In your case, more than likely not. And then last, what percentage of your retirement assets are in a guaranteed annuity portfolio. See, the definition of annuity is simple. It's a guaranteed paycheck for life. So if you have a Social Security benefit coming into you every month, that's an annuity. If you have a guaranteed pension from a public pension because you worked in the public sector, that's an annuity. If you were lucky enough and you have a guaranteed pension coming in from a private company that you work for years, that's an annuity. So the question is, are there ways that you can create guaranteed pension or self-created guaranteed pension with your assets via an annuity portfolio? And the answer is yes. Now, we don't have the time to discuss it today, but the answer is yes. And I can assure you, if you do that, your retirement life is going to be exciting. You're not going to have to worry about much. All you're going to have to worry about is waking up on the green side of the grass and making certain that you can take a deep breath every single day until the day you die, hopefully many years down the line. Now, the sequencing of return dilemma is a major issue one. And my question to all of you, if you can take a look at that graph, I'll explain it to you in a second. But how many valleys can you handle at retirement? Look at those peaks and look at those valleys. And those are things that happen. And I'll walk you through it in a second. Will you ever recover from a down market in retirement? Let me give you an example. Take a look at that graphic there. If you take a look on the left at the first peak, that was in 2000. That was when the S&P 500 reached the highest level. Over the next 3 years, the S&P 500 actually dropped 49%. Can you imagine if you would have been in retirement at that point in time? And as your account values were dropping by almost 50%, you still needed to evade principal in order to make ends meet? You would have never been able to recover. What I do want to share with you is very critical, and this is something that I want you to take with you today. Once it hit in 2003, the bottom at 49%, and started to climb again, it took until 2008, in other words, 5 years from 2003, for the market to recover. And most important, it took 8 years from 2000 to 2008 for the market to get back to where it was at in 2000. And we call that the decade of nothing, because from 2000 to 2008, nothing happened along the way. Can you imagine if you had retired in 2000? Where do you think your retirement life would be today? You would have run out of money before you ran out of life a long time ago. But let's go to the next peak. So in 2008, the market peaked again. And then in a matter of a year, the market dropped by 57%. And that was a 2008, 2009 stock market debacle. So in a year, the market dropped 57%. Once again, can you imagine if you were in retirement at that point in time and you still needed to maintain your standard of living? You were not employed anymore. You did not have the luxury to allow for those assets to recover because you didn't need to touch that money. And then from 2008 all the way down, it took until 2014, so 6 years from 2008 for the market, for the S&P to get back to where it was in 2008. What am I trying to tell you with this? Is that it's not only the withdrawal rate, whether you take too much or you take too little, but it is also the sequencing of return rate that can determine success and failure. So you never know in which sequence you're going to be retired. You don't know whether you're going to be retiring in a bear or in a bull market. You don't know if you retire in a bull market and a year later you go into a bear market, and all of a sudden now, Houston, we have a problem. So my question to you, if you have investment accounts and retirement accounts in which you would only enjoy the peaks and you would never suffer from the valleys, how much is that worth to you? And by the way, there are accounts that would allow you to do that, that would allow you to maximize your peaks. And then once the markets start heading south, you stay right where you're at. And when the market starts to recover, you continue to go in a northerly direction without ever losing a beat. But you need to do some retirement strategist and tax planning in order to be able to do that as well. Now, in 30 years of retirement, here's a question for you. How many bear markets will there be? See, most everyone has been looking, we just entered a bear market, but we have the longest bull market in American history. And that lasted anywhere between 11 to 12 years. By the way, over the last 20 years, the average rate of return for the stock market, at least a Dow, has been 4.29%. And that includes the longest bull market in American history. If I go back to 1900, the average rate of return for the Dow was just north of 5%. So many of you are taking a tremendous amount of risk for very little return. So how many bear markets can there be? Well, let me give you an example. And this is one of the areas that I want to touch upon as we end this webinar. So my question to you, after going through all these questions that I have just gone through, is your retirement plan a DEFCON 1 or is it a DEFCON 5? By the way, DEFCON is the military terms for the military systems that we use in the United States and our allies using them. You know, DEFCON 5, life is good. You know, yeah, we're ready to do anything, but nothing has been mobilized from a military standpoint, and life is good. We're getting along with everyone in the world. DEFCON 1 means that we're ready for war. We're ready for nuclear war. All our military resources have been deployed. They're ready to go. Our nuclear submarines are situated throughout the world, ready to go. The President of the United States has the finger on the button, and life is going to be really, really bad at that point in time because nuclear war is imminent. From a retirement standpoint, is your current retirement plan a DEFCON 1, which instead of being an imminent war, it would be an imminent financial failure. Now, depending on how many years you have between now and retirement, you may be able to do proper planning and get to DEFCON 5, where now you're comfortable and things are okay. But perhaps you won't be able to make it to DEFCON 5. But if you can make it to DEFCON 2, 3, or 4, you would be in a better position than you were before you watched this webinar. And by the way, from a military standpoint, the United States of America has been down to DEFCON 2 only once. And that was during the Kennedy administration, and that was during the Cuban Missile Crisis in 1962. So I try to make analogies and equate different things. So again, is your retirement plan a DEFCON 1, DEFCON 3, or DEFCON 5? So you got to figure that one out. And by the way, if you're a DEFCON 5, are your retirement savings adequate to sustain 3 decades in retirement? The answer is no. You're not going to be able to survive. Are your retirement savings adequate to guarantee a retirement paycheck for life? More than likely, you won't. You don't. Are your retirement assets at risk of the fatal 4, the risk of dying too soon, living too long, living with a disability, and living with eroding factors, taxes, inflation, stock market volatility, all of those? More than likely they're not. Otherwise, you wouldn't be a DEFCON 1. Are your retirement assets exposed to the major eroding factors? I know they wouldn't be. Will your retirement assets increase the taxation of your Social Security benefits? That's a major question. Because if you take too much money out of your taxable and tax deferred bucket and the vast majority of your retirement assets are taxable, then up to 85% of your Social Security benefits are going to be taxed. That's going to put you at DEFCON 1, as opposed to 0% of your Social Security benefits being taxed if you do proper tax planning. And I do those provisional income calculations for my clients. By the way, don't bother to ask, but the vast majority of your financial advisors have no clue what a provisional income calculation is, and it's something that I do for all my retirement clients. Will your retirement assets increase your Medicare premiums? Perhaps you didn't know this, but when you retire, the income that you generate will dictate whether your Medicare premiums will go up or not. And if you don't have any tax protection, and all of a sudden you have tax Armageddon, then there's a very high probability that not only will your Social Security benefits be taxed, but your Medicare premiums will also go through the roof. And you have to be able to do your due diligence. You see, you thought that retirement was going to be very easy, but it's not necessarily the case. And then will your retirement assets provide a guaranteed survivor benefit? If you're married and something happens to you, will your surviving spouse continue to receive that guaranteed paycheck for life? Very important, because you don't want to disinherit your family upon your death. And many of you, because of improper planning, not because you wanted to, are doing exactly that. Now, how many bear markets can you deal with in retirement? Are your assets ready for 6 bears in the retirement jungle? I don't think so. None of us can go through 6 bear markets. How will you maintain your lifestyle during all of these bear markets? And the reason why I say 6 is that if you're 65 years of age when you retire, you got to be able to plan for 3 decades or 30 years in retirement. And if you look at that graph, take a look at it. Once again, the S&P 500. A bear market occurs every 5 years. Remember, we just went through an anomaly with having a bull market for almost 12 years. That had never happened in US history before, in the stock market history. But a bear market usually happens every 5 years. So in 30 years, that would be 6 bear markets. The average decline is about 39%. They usually last 1.5 years. And it takes about 5 years, 5.2 years for that market to recover. Let me give you an example. If the market dropped 40%, it would take a 67% return in 1 year for the market to break even again. I've never seen a 67% rate of return on the market. But let's say that the market dropped 40% this year, and this is a year that you enter retirement. If you're able to gain an 8% rate of return every year thereafter, that would be a hell of a return. That would be a really, really good, viable rate of return on an annual basis. Well, even if you do so, it would take you 6.6 years for you to recover from that 40% loss that you incurred this year. And I'm not including you having to take money out of those retirement assets while the market was heading south or trying to recover, because then you will never, ever, ever be able to recover. As a matter of fact, I can guarantee you that if you have to go through a bear market and your assets are not protected, you're never, ever, ever going to recover from a bear market. And chances are you're going to go through 6 of them. Now, you may say, well, I'm not going to live 30 years. Okay, so you want to make a bet on 5? How about 4? How about 3? How about 1? Do you want to bet a bear market in retirement when you're in your mid-80s? Remember, the 3 decades of retirement, the go-go years, the slow-go years, and the no-go years. Between 65 and 75, you're still healthy. You're traveling, you're spending a lot of money, you want to see the world. Okay, once you get into your mid-70s, you go into what I call the slow-go years. Why? Because you may not be as healthy as your previous 10 years. You know, you may still be doing a little bit of traveling, but you're staying closer to home, closer to your children, your grandchildren. Once you get into your mid-80s until the time that you pass on, that's what I call the no-go years. And I do have a number of clients in the no-go years, and they tell me the same thing. Bert, all I look forward to when I go to bed at night is to wake up in the morning. So you have to manage your assets through the go-go years, the slow-go years, and the no-go years. And you have to make certain that you have guaranteed paychecks for life that otherwise you're not going to be able to do for yourself and your family. So my final thoughts for all of you as we close this webinar, and once again, thanks very much for joining me. And I'll see if there are any questions at the end. Never get between a dog and a fire hydrant. A good friend of mine used to say that to me all the time. Bert, don't ever get between a dog and a fire hydrant because you're going to get sprinkled. And that's not the type of sprinkle you want to go through. Information without education always leads to failure. So make certain that when you gather information that you do your due diligence and make sure that you build some knowledge behind it. So information without education always leads to failure. Also very important for those of you that are preparing to retire. There's a main difference between what you're retiring from to what you're retiring to. I have clients of mine that have never done that due diligence, and it's important to do that. Are you married? Is there a disparity between the ages of both spouses? Is someone going to retire and then the other one going to continue to work? Or are they both going to retire? Are they going to retire and continue to work part-time, or are they going to travel? Are they going to live abroad? So for each and every one of you, retirement is going to look totally different, and so will your asset allocation and your retirement strategies and your guaranteed paychecks. They're all going to look totally different, and your go-go years or your slow-go years and your no-go years. So you have to do your due diligence and or talk to someone like me that can help you along those lines. So what's better, a hammer or a screwdriver? I get that question asked all the time. And my answer is always the same. Well, it depends. It depends on what you want out of life, what you want out of your retirement life. Whenever I do any type of guaranteed paycheck program for my clients, I ask two questions. What do you want your assets to do for you while you're alive? And then what do you want your assets to do for you after you're gone, after you're dead? Those two questions determine the type of planning that I'm going to do for each of my clients that come to see me, and that I do audits and retirement audits on their behalf. And Nancy Duarte, which is someone that I've done some reading on, said a long time ago that the future isn't a place that you're going to. The future, it's a place you get to create. So at the end of the day, you have to create your future, and you have to do it the right way based on your goals, objectives, and desires for yourself and for your family as well. My call to action is schedule a 20-minute video conference with me. Pick my brain. Tell me all the things that are keeping you awake at night from a financial standpoint. I don't need to go to hear anything else. That would be TMI. And this 20-minute video conference call, and if we need to go longer than 20 minutes, so be it. You may have complex issues that we need to address. It will be at no cost or obligation to you. Therefore, the video call is going to determine the steps to take. Some of you may say, you know what, Bert, you sold me. I'm ready to go. I understand. I know exactly. I've seen a lot of your videos, and I have a lot of credibility and trust in you, and I'd like for you to handle my retirement distribution plan, and then I'll be happy to do that. Some of you may say, you know what, Bert, I would love to work with you. Let's give it till the end of the year. I have some things that I need to do. Let's go ahead and schedule a call a year from now or 6 months from now, and that's entirely up to you. Or the third thing is that we end up not liking each other. We start screaming at each other. We get into a fist fight and we walk away. Now, that's never going to happen. But at the end of the day, you're going to get to control this meeting. And my goal, as I always do, is to make certain that I can help you. Now, you have my information, Bert Salazar, there. You have my number, 786-766-1042. And then my email, Bert, B-E-R-T at bertsalazar.com, B-E-R-T-S-A-L-A-Z-A-R.com. And that's my story from a business perspective. And also, what I want to do is I want to tell you that, it is very important for me to have the opportunity to share these things, and I'll stop sharing right now with you, because at the end of the day, it's all about planning, but it's all about retirement distribution planning. It's about climbing the mountain of retirement, getting to the summit of retirement, and then making certain you make it safely back down the mountain of retirement until the day you die. And always remember that my goal for each and every one of you is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see actually start to change. So once again, let me see if I have any questions at this point in time. I don't seem to have any questions. Once again, I want to thank you all very much for joining me today. I'm going to record. I have recorded this presentation. I'll send it out to all of you that attended this webinar in case you want to go through it. But feel free to reach out and we'll schedule that call. In the meantime, have a wonderful day. Stay safe, maintain that social distancing, and I'll talk to you soon. Take care. Bye-bye. Give my best to your family.